Okay, welcome everyone to the CBR Symposium. Today we have two exciting speakers. We'll discuss about innovations in decentralized exchange. We have Alan from the Uniswap Labs, and he's a protocol engineer at Uniswap, where he's working on building the auction mechanism. And then we have Max Resnick, who is a lead economist at Anza. So we'll start with Alan, and then we will go to Max. So Alan, please go ahead and share the screen.
Sure. Can you guys see it?
Yeah, perfect.
Cool. I can get started then.
And just maybe just some rules. If you have questions during the talks, please ask them in the chat, and then I will unmute you and you can ask the question directly, or if you prefer, I will read the questions to the speakers.
Sounds good. Hey everyone, my name is Alan. I'm a protocol engineer at Uniswap Labs. I've been building out our various auction mechanisms for UniswapX, which is our intent-based trading protocol, which I'll briefly go over. One thing we found in this journey is that there's no one-size-fits-all auction mechanism because we're working with many different chains, different properties, block times, sequencing models, fees. And so the optimal design really depends on those properties. So we've built out several approaches to this, and today I'm here to share one of them, which is how we internalize MEV for swappers on chains that use priority gas auctions. The core idea comes from a mechanism called MEV taxes, which is introduced by Dan Robinson and Dave White from Paradigm. What I'll be presenting is how we basically taken that theoretical framework and then turned it into a production system inside of UniswapX. So this will go through like what the implementation looks like, what we've observed in practice, and interesting questions we've been thinking through along the way. So let me set up the framework that we're working with. What PGA is priority gas auction. So we are in a priority gas auction setting where the transactions in a block are ordered strictly by a descending priority fee. And that's one assumption that we need. In terms of the actors, there are three actors. One is a swapper. This is the end user who wants to make a trade. Importantly, they don't actually submit that they're not the ones who submit the transaction. They sign an off-chain message, which is what we call an intent in the system, that specifies conditions like minimum output and a deadline for the trade. The filler is just another actor, is a competitive intermediary that's going to pick up that intent and submit it on-chain to execute the trade. And third actor is the proposer. And I'm just going to use proposer throughout this talk as a catch-all, but like on L2s, this will be the sequencer, L1 validator, and we're going to ignore the pipeline of builders and relays involved with that because those details won't matter for our purposes. All we care about is that there's some actor that controls the transaction ordering. They have to do it PGA and they get the priority fees. That actor isn't the counterparty to the trade. They're just under PGA, they're the person extracting value from it with the priority fees. And that's the key tension that's kind of inspiring this setup. And that brings us to MEV as we're using the term here. So what I mean by that for this talk is that when a filler goes to execute a swapper's trade, there may be a surplus available, which is just the gap between what they need to pay the swapper and then the true market value they can realize elsewhere. So under competitive conditions, the fillers who compete should bid that surplus away through priority fees, and it gets competed essentially down to zero filler profit, and the full surplus accrues to the proposer as a priority fee. So when I say MEV in this talk, I just mean that equilibrium value that sits with the proposer after the trade. And that is precisely the value that we want to redirect back to the swapper, back into the system using a MEV tax. So just to put a formal frame on these actors, the swapper signs an intent with some minimum output Q, and the filler is going to realize some value V from filling the order. And the key here is that V is filler specific. So imagine a filler, they vary in like what liquidity sources they've integrated into their system, which exchanges they're on, how they hedge, what their execution costs are, if they have different fee tiers on different sexes. All of those are going to contribute them to having various Vs in this setup for the same trade that's proposed. So the proposer is the one that orders the transactions by priority fee, and then they're going to collect the priority fees. And the game is simple. The fillers are going to compete in a first price auction within a single block. So the auction is going to happen in a particular block in the future. All the fillers submit their bids in that one. And in that block, highest priority fee executes first, and the order can only fill once, and all of the losing fillers will revert. Their transactions will revert. Just to give a little bit more context on what UniswapX is, basically in a regular AMM swap, when you want to swap, you specify the tokens you want to trade, and there's going to be some routing algorithm that finds you the optimal path through some set of pools. Maybe it's like across multiple pools, different fee tiers, whatever gets you the best output at the time you route. But that path gets packed into call data, and the swapper is going to submit that transaction on chain to execute it. In this model, the swapper is locked into an exact execution path at the moment they sign. And that contrasts with this idea of an intent, which is what UniswapX uses. The swapper just signs a message saying they want to sell some token, and then they want at least this much of another token. And there's a deadline to it. That's it. There's no routing, there's no call data, no specified execution path. All of that is for fillers out there to figure out. So what actually happens mechanically here is the user signs a message expressing their intent, and this is like the conditions, minimum output, deadline, and there's a contract that enforces those constraints. And if the filler's transaction doesn't meet them, it's going to revert. So you can't like steal people's money. Then the fillers are going to compete to fill that intent. And here's what makes it better than a fixed transaction. The best price at the time you sign might not be the best price at the moment the order executes on chain, because the price will move between blocks. Like how far out like is your execution compared to when you like click the buttons on the screen. With an intent, the filler optimizes this at execution time. They put their best routes forward in a block in the future, and then the best one's going to be higher in the block and win. And because you're not specifying a path, those fillers can source liquidity from anywhere. So any on-chain pools across any protocol, or even kind of pseudo off-chain, a filler might fill their order with their own inventory and then hedge it on a centralized exchange. So the swapper is ultimately indifferent to how like their trade is fulfilled. They just care that their conditions are satisfied, like they get their minimum output under their conditions. So now we have the setup. Swapper signs the intent, fillers fill to compete to fill them, and the priority fees go to the proposer. The problem here is that, from our perspective, the filler surplus gets bid away to the proposer. So the proposer didn't create the value based on like what minimum amount that the swapper set. And the proposer is also not a counterparty to the trade. They just happen to control the ordering and they get the fees for that. From the perspective of the swapper and the filler, that's just a pure loss in their system. The insight here is that under PGA, we can fix this at the application layer. So we don't need to change anything about how blocks are built if that priority ordering is followed. We just need the intent to be aware of the priority fee. And then we could do that with our smart contract code. So that's what a MEV tax can give us. And I'll go into how it does it. So here's a visual about it. In the top diagram, you have the status quo. This is the swapper creates a trade. That trade has some amount of MEV associated with it. The filler is going to fill the order, but to win the right to fill it, they bid up the priority fee. And then that surplus flows to the proposer. The swapper will get their minimum output and nothing more. Now, under this bottom diagram, same trade, same MEV, but with the MEV tax, the contract is going to force the filler to give more output to the swapper as a function of their priority fee. So more priority fee, more output. The filler's total cost doesn't change because they're still willing to pay the same aggregate value. What's changing is where that value goes. So the proposer's share of that value will shrink and the difference will flow to the swapper. So the MEV tax is really essentially just repartitioning a fixed pie. The filler is indifferent. They pay the same either way, but the swapper isn't indifferent. And as like the application, we can take an opinionated stance at the application layer to say who receives that value. So
And just
yeah,
Alan, just a question. So when the swapper specify the intent MEV, this could be different from the realized MEV. Back to your previous slide.
um,
So this MEV
mhm,
that you have a circle, that's the intended MEV
yes,
that differs from the realized MEV.
yes, it can.
It typically does, right? Because you have price leakage and the transactions can execute across multiple blocks. So,
What was that?
yeah, I'm saying it typically does, right? Because there is a chain. I mean, typically when you submit a transaction, you have a price which is different from the one that you get when you execute the transaction.
Yeah,
There might be.
yeah.
Do you have a sense of how large is this difference?
Um, I think it ultimately depends on like the volatility of the sources that these
Mhm.
fillers are filling from. So it could probably vary depending on their
Mhm.
strategies. Um, I'm going to walk through a quick example before we formalize this. So, say a swapper wants to swap one ETH for 2000 USDC, and therethere's zero point 0.1 ETH worth of MEV on it. A filler is going to be willing to spend up to 1.1 ETH total to fill it. So, 1 ETH to the swapper, zero point 0.1 fees is going to go to the priority fees to win the auction. And the key here is that all the filler cares about is their total output. So they are going to be spending 1.1 ETH and that leaves their pocket. They're ultimately indifferent to where that 1.1 goes. So imagine we have two worlds. World one is the status quo where the swapper is going to get 1 ETH. Proposer gets their priority fees, zero point 0.1 ETH. And in the second world, we're going to take some portion C of what was going to the proposer and then redirect it to the swapper, where C is a positive number. The filler is going to pay 1.1 ETH, like I said, both worlds, they're indifferent. But the swapper isn't indifferent because 1 plus C is strictly better than C if C is positive. So this is the neat part because we're going to have like this Pareto improvement available from the perspective of the trade's counterparties. It's because the filler side of the trade will not suffer while the swapper side only stands to gain. So if you're deciding at the application layer, like we are, we should just choose to live in world two. And that's the mechanism for getting there is the MEV tax. So let me get into the specifics. We got this idea from Dan Robinson and Dave White from Paradigm, from this paper they released called Priority is All You Need. They basically define MEV taxes as a mechanism that applications can use to capture their own MEV. So the way it works is that your application has a smart contract, and then it's going to charge a fee that's a function of the priority fee. And in UniswapX's case, that fee takes the form of extra output to the swapper. So as a filler bids up the priority fee to win the auction, the contract is going to force them to give the swapper proportionally more output. So the filler's total cost will stay the same, but what changes is that split between the proposer and the swapper. And there's one critical assumption for this, and that's that the proposer must honestly order the transactions by priority fee. And if that holds, then the priority fee is a signal for how much MEV exists in that transaction, and the competitive bid fillers will bid it up to it. A smart contract can read that signal during execution time, and then it can charge a fee as an increasing function of it. That's the MEV tax. And a key sentence from the paper is that if this tax increases fast enough as a function of the priority fee per gas, only a negligible amount of MEV accrues to the proposer. So we're going to see like the ability to capture like 99% of the value and redirect it back to the application. So here's the intuition for why it works. It's really just three facts that we compose together. So first, we establish that the contract enforces higher priority fee, which means higher output to the swapper. Second, an order can only be filled once. Any subsequent fill from another filler is going to revert. And third, priority ordering means that the highest priority fee transaction executes first. So if we just chain these facts together, you get a clean result where the transaction that executes first is the one with the highest priority fee, which is the one that gives the swapper the most output. And it's the only one that successfully fills. Everything else is going to revert down the block. So the swapper is guaranteed to be filled by the best available offer in the block. Now let's go into how we can implement this into UniswapX. So here's a situation we had before with the naive intent. If there's zero point 0.1 ETH of MEV, the searcher bids up that in priority fees and fills it, and that value goes to the sequencer. So we should modify the intent. So before it was like the conditions of the minimum output and the deadline. What we should do is instead of having a fixed output, we turn it into a function. So we make the output an increasing function of the priority fee. So this example here is just the idea. So more priority fee means more output to the swapper. I'll get into the specific formula later on, but the 0.01 here isn't the actual implementation. The point is the pattern. So we're basically tying the swapper's output to the priority fee. And we turn the filler's bids into commitments to give swappers a better price. So now the surplus is split. What used to go directly to the proposer as a priority fee is partitioned. So some of it goes to the swapper as extra output, and some still goes to the proposer as a priority fee. And the scaling factor in that function that you use will determine that split. So naturally, we want to ask, how do we set it so that we can maximize the swapper's share without breaking anything? So back to the world two framing. MEV is 0 0.1 ETH and it's being split. So swapper gets 1 plus C from the trade and proposer gets 0 0.1 minus C. It's going to be a zero sum reallocation between the proposer and the swapper. So the filler is just going to send 1.1 ETH either way. Our optimization function in this case is really just to maximize C. So we want to push as much value away from the proposer to the swapper. And the scaling factor that I was alluding to earlier will be that lever to control C. So a higher scaling factor means the more of each priority fee unit is going to translate into more swapper output rather than proposer revenue.
And Alan, there is a question on the chat on the Q&A. Alfred, please go ahead and ask.
Oh, thank you. So today, a lot of the fee payments are made by direct transfers to the wallets of the builders, and this is an easy way to circumvent the tax. And by the same notion, it is true that transactions are not ordered based on priority fee because of the side payments to the block builders. So the question is, how reasonable is this assumption that ordering is purely based on priority fee and that there is no side payments made?
Yeah, yeah, yeah. So one of the big assumptions of this setup is that PGA is followed. So like I said in the beginning, when we have different chains with different setups and environments, we have different approaches to our auction mechanisms there. So we do not use this on L1 precisely because of what you just said. Because of this builder, the PBS interactions, like this isn't going to work. So we don't use this on mainnet. We use this on base, where base does follow PGA. So this mechanism is what we use on base, but it is not what we use on first come, first serve on Arbitrum, and it is not what we use on mainnet, which is PBS.
Thank you. And Andrea also has a question. Andrea, go ahead.
Yeah, hi, can you hear me?
Yes, I can.
Yes, okay. I was just wondering, so there seems to be an issue with the unit of measurement in the sense that, say, gas is in ETH, and I want to swap USDC for Uni.
Mm-hmm.
And essentially what's going to happen is that I'm going to be executed at the at my limit price, so the worst possible price I was willing to accept. So I'm going to be executed at a very bad price, but this mechanism gives me back some ETH, right? So
Yeah, so
what
this
I
is,
receive back is a fraction of what the whatever the filler paid to get their transaction earlier in the block, which is okay.
yeah,
Just say it's a bit strange, and it becomes even stranger if I am selling ETH. So I'm selling ETH for something else. I get a variable price, but I get back some ETH.
yeah. Just to clarify on this, the example I'm using is having ETH as the output, right? So if the output was uni, like you said, basically, I'll get into the formula later in this talk, but essentially what happens is as you increase the priority fee, it's going to increase the output amount by a certain percentage in that unit. So if it's uni, like if my output was 100 uni, and then you increase the priority fee, there's going to be some kind of scaling that's going to be like, because you increased it by that much, or because you set that value for the priority fee, the output is going to increase by 2%, say.
But
So
doesn't this require sort of Oracle to tell you a price between unit and ETH?
no, because it's completely relative to the minimum amount that the swapper set. So the execution amount is just the minimum amount. So example is 100 uni. And then based on what priority fee they set, the execution amount is just some percentage above 100.
Okay, maybe we can see the formula later.
Yeah,
Thank you very
sure.
much for your answer.
Yeah, no worries.
Yeah, there are a couple of other questions. One is by Mahmoud. Maybe I mute him. Please go ahead.
Can you hear me?
Yeah.
Yes, I can.
Thank you. UniswapX is an RFQ, correct?
Um, on mainnet, we run the RFQ. Because of PBS, we can't run this. So this is our biggest thing on base. But yes, on mainnet, we use RFQ.
And so you're not running this on mainnet. So you're just using like something behind the scenes, kind of like a V4 system to implement this whole system to
Uh,
extract the priority fee. I'm trying to understand where this priority fee is being pulled from. Um,
yeah. So we organize these into different reactors. So technically on mainnet, there it is using a Dutch auction reactor, but we initially do an RFQ, and then the Dutch auction is a fallback to that. And in this case, on base, we deployed a priority reactor, which is for this MEV tax. And then in that reactor contract, it reads the priority fee on transactions in order to compute execution amounts, which is not the case on the contract we deploy on mainnet or other chains.
I see. So this is unique to like base.
This is unique to PGA chains. So we run this on base and Unichain.
Gotcha,
Or
gotcha.
just any OP chain, if they get big enough to warrant deploying to.
Okay, thank you.
Yeah.
Yeah,
And
good question.
just a last question by Brian Zhu. Brian, go ahead.
Okay. Hi, Alan. So my question is, what happens if you have like, say, a adversarial sequencer that sees these fillers transactions and then censors them and submits their own at like a lower priority fee? Like what guardrails are there to prevent this sort of activity?
So that is one of the key assumptions made in that paper that proposed this mechanism. So it must be the case that it's honestly ordered. And then in our case, like from the engineering perspective, you could probably do that with a TEE. So Base does not have this like we cannot tell if Base is 100% doing this honestly, but like we can see that transactions are being ordered with priority, but we also don't know if they're censoring. So it's kind of like some idea of trust there, unless you use a TE or any other way to protect against that.
Thanks.
Yeah. Carry on.
Cool. Yeah, I think I just finished with this. So there's another key idea from that paper, which is that if the tax increases sufficiently fast as a function of the priority fee per gas, then only a negligible amount of the MEV will accrue to the proposer. So what that means visually is like the scaling factor is essentially the slope of this line. So however much extra output the swapper gets per unit of priority fee increase. So if you make that slope steeper, more of that surplus goes to the swapper as output, and then less goes to the proposer as fees. So if we make it steep enough, we can redirect the vast majority of the value. So I'll put some numbers on it. On the left, we have a slower scaling factor. So out of the 0.1 ETH of MEV, swapper gets an extra 0.09, proposer gets 0.01. That's 90%. On the right, it's a steeper slope. We made it 95%. So same filler cost, same total MEV. We've just shifted who receives it by changing the scaling. So the natural question would be like, why not make it almost vertical and capture everything? There's a trade-off to that. If we make the slope too steep, we will lose granularity. So if we imagine the output is denominated in USDC and the scaling factor is so high that a single way difference in priority fee changes the required output by 20 USDC, there's no smaller unit than Wei. So there's no way for a filler to bid anywhere between those two output levels. So the auction becomes coarse and the filler can't meaningfully differentiate their bids, which will reduce the competition that the mechanism depends on. So we can't crank this scaling to infinity. But that being said, Wei is already an incredibly small unit. And on L2 specifically, like where gas fees are low and block capacity is large, where we're running this, the proposer's total take from priority fees is so tiny to begin with. So in practice, we've been able to set scaling factors high enough to capture nearly all of it without running into granularity issues. It's a theoretical constraint that matters for the design, but it hasn't been like a binding constraint for us in practice. So now we're getting to the what we're actually doing in production. So the top line is the general pattern we've been discussing. So it's like this additive scaling. Our implementation is multiplicative, which is shown on the bottom. And the intuition here is like pretty simple for what we're doing. For each extra way of priority fee per gas a filler specifies, they're going to owe the swapper one extra MPS of output. So we called this MIPS, which is just 1,000th of a basis point. And that's essentially our unit of granularity. So for every extra one way of priority fee, you're going to increase the output by 1,000th of a basis point. And this is why the granularity concern I just mentioned wasn't too bad for us, because 1,000th of a basis point is already incredibly fine. Like it's a very fine increment, and fillers can compete with each other at extremely high precision while the mechanism is still capturing nearly all the MEV. So in practice on L2s, we're redirecting over 99% of that away from the sequencer and back to the swapper. So the scaling factor turns out to be a relatively forgiving parameter to set. So there's a very wide range for us in practice where we'll get excellent MEV capture without sacrificing meaningful competition.
And there is a question by Karthik. Karthik, go ahead and ask.
Go ahead.
Hey, so basically my question is like, for how does the system work in a world where like the underlying liquidity sources, so say the like AMM is charging its own priority fee, like MEV like tax effectively to internalize arbitrage on the pool itself. Because then you have an issue where like this system is charging a fee and then the pool is also levying a fee on that tax, and then there's like a form of double spend, which this could then penalize like the best liquidity source because of it.
Yeah, exactly. This thought has come across my mind before, and it's this idea of like, if we had many applications using this idea, there can be consequences because like, for instance, if in our case you increase the like your priority fee is X value, right? And then that ultimately increases the UniswapX output by like 1%, but then that same priority fee value on the transaction when they're routing through the AMM penalizes them like 200% or just some crazy like non-matching number there, then it completely breaks. Yeah. So there would have to be some kind of like standard or readjustment to that. But we don't see that right now, but theoretically that is true. And then it's this like cross-application MEV tax that interact with each other that can break.
Yeah.
You're right.
I asked specifically because we're launching a Union for pool like tomorrow with
Oh,
this.
let me know how it
And
goes.
yeah, I will. And so I'm wondering, do you have like an order of magnitude in terms of like the average priority fee setting for these transactions in practice?
So what happens is like the bids for these trades ultimately end up like very low in the block, because their priority fees are all like basically super tiny. They're kind of just like symbolic, right? Like they maintain their relative ordering relative to other fillers, but their absolute values are extremely low.
Awesome, thank you.
Yeah,
You can go ahead.
cool. So just to state this mechanism more formally now that we have that equation that we're using in the code, the contract enforces that the swapper's output is Q times 1 plus some scaling times the priority. So it's a minimum output that is scaled up by a factor that's linear in the priority fee. So the filler is going to choose their P freely, but a higher bid in that P commits them to delivering more output. So the filler's total cost has two components. Actually, can you guys see my mouse if I hover?
Yeah.
Okay, yeah. So two components. This is going to go to the swapper, and then this is going to go to the proposer. So the filler participates as long as the total does not exceed their realized value V, which is what we discussed earlier, like filler specific, depending on their liquidity sources and costs. So the equilibrium bid will follow the like first price auction logic, where the winning filler bid expressed by this, you can from this derive the split directly. So this is the swapper's share of that, and then this is the proposer's share of that. Just to point something out here, the ratio is entirely determined by Q times the scaling factor, lambda, relative to the gas used. So on L2, gas used in this expression is super tiny, and we're talking like fractions of a cent. So even a modest lambda scaling factor gives you an overwhelming MEV capture. So as this Q times lambda dominates the gas used, the proposer's share basically will vanish. So this relation right here. And another thing that falls out of this math is like when you have a larger order, so like relative to like other trades of the same asset, a larger Q is going to capture a greater share of their MEV at the same scaling factor, which is a nice property since larger orders tend to also have more MEV at stake. And the theoretical limit is lambda going to infinity, but in practice, like that'll narrow the priority fees into the super narrow interval, which is going to mess up the granularity. So there is that trade-off, like I mentioned before, but as we've seen in production, it is a pretty generous one. So as an engineer, like I'm not too worried about that. But I am worried about other things. So we've actually spent more time thinking about the auction coordination itself. So the MEV tax will only work if there is meaningful competition within the same block. So we want everyone to be bidding in the same block. We enforce that. And so we run what is effectively this timed sealed bid auction. So we're going to announce this intent to all of the fillers and then give them about 4 seconds to fill their transactions targeting the same block. And the priority ordering within that block will determine the winning filler. And this 4-second window is a practical parameter that we've tuned. Basically, the idea here is the shorter it is, the less time fillers have to find liquidity and submit. So there could be less competition if you make it too short. And it could also start becoming a latency game because if the window's tight enough, the auction will break down to whoever has the fastest infrastructure rather than the person who has the best price. But having it longer is also worse latency. Like we don't like that. Max doesn't like that. We've landed on 4 seconds as some reasonable balance, but there's no formal analysis behind this number. It's really just like empirical from what we've tested out. So it'd be interesting to get like some more rigorous treatment of like this optimal auction window duration. Like how short can we make it without like messing up the pricing for the swappers? Other thing is in practice that we've seen is on base where flash blocks basically produce very fast subblock intervals. The fillers can't reliably target the right subblock for the target auction block. So what they do is they're going to spam multiple copies of the same transaction across subblocks to make sure one of them lands in the one it's supposed to. And all of them except for one, if they win, is going to revert. And this is very wasteful because it's effectively turning what should have been this first price auction into an all pay auction where all of the losing bids are going to have real costs. And those costs matter because on chains where like the base fee is non-trivial, the reverted transactions are going to consume gas. Those costs can add up. And if they're high enough, the marginal filler will stop participating and it's going to undermine the competition of this system. Fewer fillers will mean less competitive bidding, which is just worse outcomes for the swappers. So I think there's some interesting questions here on like how do like participation costs from revert risk and gas affect like the equilibrium set of these fillers and like ultimately like how well off the swapper is and how much could something like revert protection help if it's introduced here. So that seems kind of intuitive, but be cool to see like more formal thinking and investigation around there. So on Unichain, we've designed around these problems where fillers can schedule their transactions into a specific block, which is going to eliminate the need to spam across like many transactions and hoping one lands. Another thing we did is provide revert protection. So if a filled transaction would revert, it's basically just excluded from the block. So the filler is never going to pay gas for a losing bid. Together, these things should substantially like improve the economics for participating. So you don't, with the scheduling, you can remove the timing game. Revert protection should remove this like all pay cost structure that kind of emerges. And a filler can basically submit one transaction targeting the correct block, which is the auction target block. And if they lose, it costs them nothing because if they lose, it means it would have reverted, which means it is omitted from the block. And that's going to be much closer to the theoretical ideal, which is just like this clean first price seal bid auction where the only thing that matters is your bid. It's not going to be like your infrastructure or your like calculation of these revert costs and absorbing whatever comes out of that. But if you don't control the design of a chain like Uniswap does, you can't do this. So this is definitely like a pro building full stack from protocol to blockchain if, for all those applications that are spitting out their own chains these days. One more extension to this is on chains that don't support priority ordering, we use Dutch auctions. So namely like on Arbitrum, it's just first come, first serve. We run our Dutch auctions on there where the price will decay over time until a filler is willing to step in to fill it. And this works, but it has like a blind spot because the decay curve is set when the order is created. So if the market moves in the swapper's favor during the auction, so say like the price of ETH spikes up, the decay curve can't react to it. And so the filler effectively fills the swapper at a stale decaying price and then pockets the difference because it's only going down and it can never go back up. And that value should have gone to the swapper. if you are on a PGA chain, what you can do is you can layer this MEV tax mechanism on top of the Dutch auction. So now you have two mechanisms working together. One is like the decay handling that normal price discovery over time. It's like the fallback to make sure the order is going to get filled. But then there's this MEV tax on top of it that's going to handle the like intra-auction volatility. So if the price spikes during that auction, fillers can compete by bidding higher priority fees, which will push the swapper's output up to reflect the new market price. So using them together definitely would make it those auctions more robust if you were on a PGA chain. So I think the interaction between these two things is also pretty interesting. Last thing I want to flag before wrapping up is, I guess somebody asked a question about this, but like these MEV taxes aren't limited to intent-based systems. Like you can add them to an AMM as well. So today, like the arbitrageurs are trading against stale pool prices at the top of blocks, and they can extract that value. That's the LVR. But an AMM can charge a fee on the first trade in a block as a function of the priority fee, which can basically effectively auction off like the right to arbitrage the pool first in a block. And that would redirect this value back to LPs instead of the proposer with the priority fees. So and also there's many approaches to solving that problem, but just pointing out that MEV taxes could be one of them. And more broadly, any application where value is leaking out of the application through priority fee competition could use this pattern that I showed you guys today. So that's what we've been building. That's what we've been thinking about. I'd love to hear you guys' questions and thoughts, especially on the challenges I flagged. So thank you all.
Thank you, Alan. I think we are right on time. We have a couple of minutes in case there are questions.
Sure.
I mean, we can always get questions also at the end of the webinar. So maybe let's move to Max and then
Cool. Let me get this out of your way.
Can you guys hear me all right?
Yeah, we can hear you. We cannot see the slides.
Okay, yeah. Share these.
Yeah, great.
Good.
Yeah,
Sweet.
nice picture. Yeah.
Yeah, I'm always very happy to see the clean MEV of Ethereum, and then we go into Solana and it's like, I don't know. We don't write any theory because by the time we write down the equations, the game has changed to the point where the equations don't mean anything anymore. So with that said, there will be no equations, only data. The data will be stale by the time I finish the presentation, but hopefully you guys can get an idea of what things are like at a moment in time. And that'll be sort of one of the themes of today's presentation is path dependence. So everything is always changing on Solana. Nobody writes anything down. Nobody publishes their code. And so it's just sort of in this constant state of flux and cat and mouse games. As a little preview of what we'll see later, this is a type of plot I like to do. I first did it in ETH, comparing the arbitrage bots with the builders, so you could see the integrated builders. And I've just been running it recently on some of our new internal data sets to see where the routers are sending flow, where the front ends, like Axiom, are sending flow to. And yeah, so on the right side are the regular AMMs. Those are mostly going to be the long tail meme coin fills. And on the left side, those are all the prop AMMs. Okay, I'll start with a little bit of an introduction to Solana, like 4 slides, just very short, because we're going to get into some of the nitty-gritty details of how Solana programs work, because that's what the prop AMMs do. So we sort of need a little bit of background on what an account is and what a program is. So the most basic unit of data on Solana is an account. It has a pub key. It has LAN ports, which is sort of like Way. It's the smallest atomic unit of Solana. It has some data, and then it has an owner, which is another account. So some accounts have data which is compiled bytecode, and then the owner is a loader, which tells the runtime how to interpret those bytes of bytecode. And those are programs. So that's our version of a smart contract. And instructions are the smallest unit of computation on Solana. Each instruction has a program ID. So instructions call programs. And they can also have instruction data that's sort of like call data on Ethereum. So putting that all together, transactions have an access list, which is which accounts do you want to read, which accounts do you want to write. They have a signature, which is that pink looking thing at the top. They have either a recent block hash or a nonce advanced instruction. And then they have a bunch of other instructions, one of which might be setting the priority fee or setting the compute limit. But the other ones might be do a transfer, do a swap, interact with this prop AMM. So that's sort of all those building blocks come together to form a transaction. So accounts contain data. Sometimes that data is bytecode. And if the owner of the account is a loader that the VM knows how to interpret, then that makes the account a program. Instructions can call those programs. Transactions contain more than one instruction. And a fun fact is that the BPF in BPF loader stands for Berkeley Packet Filter. And the story of why we use that is that Anatoly wanted to run all of the execution computation inside the network interface card to make it go faster, which doesn't make any sense at all, but that's sort of why we have BPF. Okay, now some more background. All of this is very pleasant. We'll get to the unpleasant and scary parts of the dark forest soon enough, but this is just all background. So we don't have a mempool on Solana. You send your transactions directly to the leader, sometimes through an RPC like Helios or Triton. You call this send transaction. It sends a packet over quick to the leader. Each leader has 4 slots in a row. Usually you send to the current leader and maybe the next leader in case you're on the transition boundary. And yeah, so there's no mempool. There's nobody looking at your transaction other than the leader. And then sort of similar to other blockchains, the leader sends your transaction to as part of a block to the rest of the validator set. Those validators vote. They send votes back to the rest of the network, and hopefully we confirm the transaction. And eventually you receive the confirmation notification from the RPC server. So this is very similar to ETH. The difference is that we don't have a mempool. Of course, 80% of ETH mainnet transactions don't go through the mempool nowadays anyway, but we never really had an in-protocol mempool. And then this is a sort of big conceptual difference. And I was talking to Eugene Chen, who's at Ellipsis Labs. And yesterday he told me their internal model of Solana was that it's sort of a continuous system where state updates are continuously being propagated. People are reacting to those state updates in real time, not at slot boundaries. And so that's sort of their internal trading model. We'll get to why or why not that might be correct today in a few more slides. But so one way to think of Solana is that everything's happening continuously, and there's always these shreds being streamed out, and you're always reacting to them. And just to put a number on that, if you're in Europe, which is where a lot of the stake is, and you send a transaction and the leader is doing normal things and not delaying them, you can actually get an update of the transaction threads sent through Turbine within 60 milliseconds. So it can be quite fast. If the leader's in Europe and you're in Europe, you might find out pretty quickly what's going on. So there is a lot of real-time updating happening even within a 400 millisecond slot. And this is a leader who is running the default client with the Jito mod. So you can see on the bottom these regular non-vote transactions. These are just normal TPU. That's the transaction processing unit. So those are just sent directly to the leader and landed. As you can see, they're landed in real time throughout the slot. And there's also this Jito auction going on separately. So these are revert protected auctions. They happen every 50 milliseconds. That's the second column here. I'm showing you this validator because if I showed you a different validator, it would be a different picture, but we'll get to that later. And this is another view. So the x-axis here is POH tick, which is this internal system clock of Solana, which doesn't really work that well, but it works well enough for this purpose of seeing when transactions are sent out. And basically, it's just this repeated hashing where you sometimes insert transactions and concatenate them with your 62,500 hashes that you've already done. So it gives a sort of internal system clock. This is from our internal data where we associate the transactions when they actually came in to our system. So you can see the POH tick, which is the cryptographic system clock, and then on the bottom, the same slot window, the same transactions on a 1.6 thousand millisecond leader window. So you can see it's relatively similar here. And at the end, that's just because it's time for the next leader window. So the real wall clock time from our monitoring systems does sort of match the POH tick monitoring as well. And we only just started doing this wall clock monitoring for trades. So I'm going to update my dashboard with it soon. But right now it's just internal data. Okay, so now we'll sort of get to the meat of what's going on and the interesting stuff that's happening on Solana right now, which is this prop AMM revolution. And it's been going on for almost 2 years now. It's sort of very active. There's over 10 players now. Many of them are quite sophisticated trading firms. And we'll sort of talk about that whole evolution, how we got here, what's going on today. And then I'll show you guys some more data that we have that's a little bit more interactive. So again, this theme of path dependence is really important because as an economist, I always like to think about the equilibrium, which is the end state. But Solana almost never reaches equilibrium. We're always changing things, everything. There's many, many people changing what they're doing. There's three important actors here. So there's the validators who are running the scheduler. There's the prop AMMs who are writing their programs. And there's the routers who are choosing where to send the flow. All three of those are changing everything all the time, sometimes intentionally, sometimes unintentionally. And that causes, a very hard to predict system. And so again, that's why we don't write a whole lot of equations over here. We just sort of look at what's happening because by the time we wrote something down, it would not be true anymore. But let me sort of tell you the stylized story of how we got to prop AMMs. So early days of Solana, not depicted on this chart, there was a central limit order book. And it worked sort of well until there was any sort of load on the system. And then that fell over really quickly and people couldn't really quote on the order book at all. So the normal AMMs like Radium, Orca started to take over because you just couldn't land enough transactions in quick enough time to actually update your quotes on the order book. So for a while, that's sort of before Phoenix order book began. So there was an initial era of the first order book, and that one was really expensive and didn't really work. So it quickly, as soon as FTX stopped quoting on it, or Alameda stopped quoting on it, it just kind of fell over. And there was this period of Orca and standard X times Y equals K AMMs dominating retail flow. At that point, Jupiter router started and would route between the various AMMs. So then after that, Phoenix, which was this central limit order book developed by Ellipsis Labs came about, and they integrated with Jupyter. So by this point, all the front-end router flow was coming through Jupyter. Phoenix integrated with Jupyter and allowed you to quote on an order book against the passive AMMs. So Phoenix then, basically because you can quote just slightly tighter than the AMMs, began to dominate retail flow. At some point, it was over 50% of Jupe front-end flow because it was a way you could be integrated with the front-end flow, but be an active participant. Then around the same time, this protocol called Leaffinity, which actually just shut down, this is sort of 2.5 years ago now, starts quoting with the very first prop AMM. It wasn't called a prop AMM at the time. It was just an AMM with an oracle that you could update, and it was just quoting around, I think, the Pyth oracle, basically. So that was happening. Then congestion happens, which means we got way more transactions than we could handle. We already couldn't handle them, but we got even more transactions. It became even harder to land. And what that led to is, if we go back to my continuous stream, we would use up all the allocated CU for the slot right at the start. And so there'd be this huge auction right at the start of the slot, which was for TPU transactions. And then the only other way to land was through Jito throughout the rest of the slot. So that was like a big change in the market structure. Like it became impossible to quote on Phoenix at that point. So at that point, people are saying, what's the next step in the market structure here? We can't really quote on the order book because it's really hard to land. But there's this huge pileup of transactions. So what happened is they realized we can make this really small Oracle update that we pipe in our own fair value, and we can quote around that. So that was Rubicon, which was sort of the first Leaffinity style quoting done by an actual trading firm. They actually weren't able to get integrated with Jupyter. But other prop AMMs, SolFi, ZeroFi, Obrick, which I call the first triumvirate, were able to get integrated with Jupyter. So they integrated with Jupyter, and that sort of kicked off this huge, crazy prop AMM race. Partly because at the time was the peak of transaction volume on Solana around Trump and Melania and later Malay. So that was sort of the highest volume days on Solana were around when these three prop AMMs were dominating. Now everybody starts to notice how much money they're making, and some more sophisticated players get in. So Humidify, I think it's public that this is SCP and Temporal. Tessera, I'm not sure if it's public who they are, but SolFi is public as well. That's Ellipsis Labs. And then later, now we're sort of getting into the modern era. I forgot a space there. But we have even more sophisticated players, Bison Phi, Scorch, Aquifer, Alpha Q. It's getting really crowded, and there's not that much profit left at least in the majors right now. But it's sort of much more mature now, even just 2 years later, than when the Rubicon AMM was being conceptualized. So I think one of the things people know now is that this idea of priority per CU is super important for prop AMMs. And the reason it's important is because per CU is on the bottom of the denominator when we prioritize transactions. So I talked about that huge pileup of transactions. Well, how did we choose which one to pick first when all the transactions are piled up? We have this quotient of cost over reward. So here you can see basically the multiplier is your reward times the multiplier to make sure we don't overflow, divided by the cost. And that means that a smaller transaction, which has a smaller cost, gets effectively higher priority in this priority queue. And this is something that we have this paper that was talked about in the last talk, which is all you need is priority ordering or whatever it's called. Priority is all you need. But actually, at the time, I don't think Dan nor myself or Dave White actually knew that you had implicit Oracle prioritization through smaller transactions. So this was going on Solana. I don't think anybody even had a name for it, but that's why the initial prop AMM started, was because the Oracle update was super cheap and it was getting prioritized. And in fact, it was even getting prioritized in the Jito auction as well for the same reason, because it was small. So we inserted into this queue in order of reward over cost, and then we scan through it one by one, making sure that we can actually sequence it. But you get the idea. If it's smaller, then it will go first. And that's effectively cancel priority because you can adjust your quotes. So that's something that people have heard about. Here's just an example. On the left is a swap on SolFi, 300,000 nearly CU. On the right, less than 1,000 CU for the Oracle update. This one doesn't have a priority fee, but you can imagine you put a priority fee on this, it only gets slightly more expensive, and you get 300 times more priority for each dollar of priority fee you spend because of the cost in the denominator. Oh, wow. Okay, so that's sort of why it started, but it's certainly not the only reason, and maybe not even the most important reason that prop AMMs have been successful so far. So let me go into some other less well-known ones. And one thing that's nice is the models have gotten so good that if you give them the raw bytecode and you sort of compile it for them, and then you just give it to them raw, they can read it and they can sort of figure out exactly what's going on in there. Especially if you know what to look for, you can prompt it and it will find even more details about the thing that you've heard is maybe going on, but you didn't know it was there in the code because it's closed source. Well, you just grab it from the chain. That's what this Solana program dump does. That's the Solana CLI. Take the raw bytecode from this program and dump it to some file on my computer, and then compile it. This is SPPF disassemble. This is like a library that Blue Shift put together. Then you can ask the model what it sees, and it will tell you a lot of interesting things. So here's what Codex 5.3 saw in these programs. For SolFi v2, that's the top one. There's a fast and a big blacklist update path. There's a third separate rule table style check. There's instruction sysvar parsing, Jito don't front constants. In Goonfi, which is a great name, there's a Bloom filter, which is also blacklist. ZeroFi has these different paths for different routers. It tries to detect who's a taker and who's not. This one, 9H6, is Humidify. It has different behavior for different routers, and there's some other interesting tricks from Humidify that I'll show later. Obrick, I have no idea. It's not super active anymore, but it's apparently the largest binary. AlphaQ, I don't think its loader awareness is anything. I was looking at it a little bit. I think it's just for upgrading the program. And then some of these other ones are a little newer, and they don't have as much obvious sort of SVM tricks in them, but obviously they have a lot of tricks going on in how do they calculate the fare, how do they put out the liquidity, et cetera, et cetera. So this is a fun, yeah.
Can I ask you a clarification? Like maybe just like at a broader level, these programs are like way of personalizing what you do in Solana. Like it's like the equivalent of hooks on Uniswap, or it's
I guess there is no standardizing hook interface
yeah.
like Uniswap has. So these are just programs on Solana, and the routers hook into all of them, and they just try to sim them and see which one gives the best price. So these are sort of the market makers in the system. The router is the matching engine, and the chain is the sequencer.
I see. And everybody can submit a program and be a market.
Anybody can submit a program,
Yeah.
but you have to get integrated with the router if you want the front end flow.
Okay.
Which has been a bit difficult in the past, although I think it's much easier now that everybody has standardized behavior. But yeah, you basically just make a program, you do some BD with the routers, you hook into Jupyter, and then if you're providing better prices, they'll start sending you flow. And then if you do bad stuff, they'll kick you off.
Yeah. Yeah. Thank you.
Yeah, so let me talk about the blacklist first. So this was one of the first tricks. The basic idea was you go, you run your markouts, you rank them by who is the worst trader against you. That's the most toxic trader. And you just deny them. You just put them on the deny list. And then this is something that when the traders see, they're like, wait, I can just deny Wintermute from taking against me. Yeah, you can do that, but then what is Wintermute going to do? Well, they're going to go and move to a new address. Okay, so then you write some automated software that tracks which address Wintermute is trading from and bans them. Then they fragment their address into many, many traders, and you have to try and ban those. Maybe they're moving all the time to fresh addresses. The one thing you can't really do is look at the history of the account. So you can't really look at who funded the account, how recently it was funded, what the other trades were, at least within the program itself. So then there's some other stuff going on, which is monitoring where the taker is doing stuff. So the blacklist is this huge cat and mouse game that has taken a lot of hours of the brightest minds of Solana just trying to get around each other's blacklists, blacklisting each other. But not all of the prop AMMs have a blacklist. But some of them who have been around a while are using this, and you can see it show up in their volume. So they have lower volume because they're not getting hit by ARB bots. And then they're just sort of only filling retail, or at least that's the goal. Any questions about the blacklists? Or I'll keep going with more tricks. Okay. And then the next thing that I think is super interesting is this idea of router gaming. So this one was, I think, discovered after the first iteration of the blacklists came out. But people realize you don't have to show the same quote as you actually fill. There was a talk yesterday at ETH Denver that went a little bit viral on Twitter about how this is going on Base, where the sim only happens at the end of the 2-second block. But there's obviously stuff going on in the 10 intermediate flash blocks. So the router or the prop AMM on Base will quote super tight in the last flash block and then super wide in the rest of them. So that's a cool idea. We've been dealing with ideas like that for like 9 months. And I often get called in to help with the router deal with these guys who are trying to trick it into sending them flow. These are 5 different Humidify Sol USDC pools. I'm just going to let it play for a second. People can maybe try to figure out why they have 5 different pools and what's going on. So I think the basic idea here is that you have 5 different pools so that one of them is always quoting tight and the target of the router. And by the time the router transaction actually gets there, it's in wide mode. And I think that's probably what's going on here to some extent. I think the second one is the very small liquidity version, so for very small trades. But the rest of them you can see are really doing some very interesting behaviors. They're not in sync at all. Some are wide while others are tight, which doesn't make a whole lot of sense if you're reacting to volatility. And then you can sort of see it in the fills if you look. This was, I don't know what BisonFi is doing now. This was something I did like a month ago. But BisonFi, I don't think was doing this behavior at the time. And Humidify was, and you can sort of see the fill quality. Some of them are tight. When you hit it tight, you get a good quote, but a lot of them are pretty wide. And so, yeah, that's not the only behavior that we see for router games, but it certainly was one of the first ones that people started to notice because other people have plotted this before me. This is not the first time somebody plotted this GIF. And they were like, wow, this is kind of crazy that you can just do this. Another thing that people have started to do recently is fully utilizing this system variable. So you can read all of the instructions from the transaction with the sysvar instructions call. So what can you do with that? Check for Jito don't front. This is a account tag that you can put in your transaction that makes it so that Jito won't put bundles with transactions in front of the transaction that you're calling in it. So don't bundle is another sort of code word for this type of behavior where you just don't want to be bundled at all. So one thing that people are doing, and I saw it in particular in SolFi when I decompiled it, but you can sort of see it in the other ones, is that they include these checks to make sure that there's no bundles or no front runs on the trade that's trying to hit them. Another thing you might do is you might read the priority fee and you might do MEV tax behavior with the priority fee, widen out if the priority fee is high. So that is also happening. There's a few other things you can do. One of them is not exactly great. You can read the slippage tolerance of the trade with the instructions. So if you want to, you can just read the slippage tolerance of the trade, set the trade to the slippage tolerance, and give the worst price that the user is willing to accept. Obviously, this is not great for the user, and this was happening recently on one of the routers where they would quote really tight, and then they would read the slippage tolerance, and they would widen out and give the user the worst possible price. Okay. Last one I have in my presentation here is the scheduler war, which is ongoing on Solana. We had a beautiful 5 years of people running the default client with the Jito mod. Now we are well past that, and I'll show you guys. Can you guys see this screen? Or is it still the slideshow?
Yeah, no, we can see the screen.
Okay. Yeah, so this is a dashboard I've made to start tracking exactly what everybody's running. 8 different scheduler types, probably a few more if we really got into the details. But each of these guys is doing something completely different. Let me see if we can pull one of these up. This guy is running BAM. And what that is it's an extension of that Jito 50 millisecond auction where you can sort of see the TPU transactions are also going into that 50 millisecond auction. Here's Harmonic. You can see that they're releasing right at the end. What they're doing is effectively ETH style PBS, where they have an auction with multiple builders competing to see who makes the most valuable block. And then they choose it and they send it out at the end. This one should be on Agave, but they might be running a mod. Yeah, so this one is sort of running default Jito Agave. Let's see. Frankendancer revenue. This is running half Agave, half Firedancer. And they're ordering almost everything at the end of the slot. Um, this one is going to be similar to normal agave behavior. I don't know exactly how this one works. There's like almost no documentation about this one. Um, and then FireDancer is now testing on their clients. This is sort of a little bit inaccurate on this one in particular because they're just churning through the POH ticks really fast. So if you look at the timing data for this scheduler, it's a little bit more spread out than this. But they are actually sequencing throughout the block. It's just that then they like put a bunch of really small fee transactions right at the end. So, and then there's people running Agave without Cheeto as well, like a bit. And so we're starting to see like a massive deterioration in the market structure as people are running 8 different scheduler types. You can imagine that if you're a prop AMM, you have 8 different games to play depending on which scheduler you're running on. So that's a lot of the interesting part of the game today is figuring out exactly how you want to play depending on which battlefield you're on. Okay. So this is sort of my mental state when I'm thinking about Solana MEV lately because there's just so much complexity and it's always changing all the time. And you really need to know a lot of institutional details to understand why the data that you're seeing looks like what you're seeing. So you might see like you might look at one slice of data, which is how the prop AMMs are quoting, and it looks like they're quoting really tight, like zero point 0.3 basis point spread. Then you go plot the fills, and it's like 2 bips or 3 bips or 4 bips wide. And you're like, what's going on here? And then you sort of plot a broader range of fills. You start to see like some are 30, 40 bips wide. Why are those happening? Anyway, you need sort of a lot of additional context. So that's what we've been trying to track down. We've been sending a bunch of transactions from various front ends, figuring out exactly where they're routing to, making sure that we have all the AMMs and front ends tagged. And then we're doing a bunch of open source data work to make it easier to do this stuff. So one of those was Jetstreamer, which allows you to stream historical state updates. And then we're doing an account state updates database as well that we're going to be releasing soon. Then we have some more like processed stuff. So people will be able to see what the prop AMMs are quoting and also all the trades on the prop AMM. So we're going to be releasing those soon so that more people can take a look. That's all I had prepared for the slides, but I can take questions.
Hey Max,
You did, Agostino.
it's good, really good work. Just to, I don't know, maybe it's a fundamental question, like I might have missed it, but the updates that are being sent in prop AMMs, are they Oracle updates? Are they bid ask? Are they spreads? What are like, or is it all the above? Can you give me kind of insight into that a little bit?
Yeah, so it's a little bit hard to tell exactly what information is being sent in these Oracle updates. We know that they're small, so there isn't a lot of data. We know it probably contains a fare. It may contain some information about what the trading firm expects the volatility looks like. It might contain a flicker instruction. So going back to the GIF, um, these are like you have to change the state to do this. So there's a flicker instruction going on here where it's like, do you quote wide or tight? It may contain updates to the blacklist. In many cases, it does.
So you can kind of program whatever you want to determine what the final bid ask spread could be. So you could say, I'm going to send a volatility. I'm going to send a spread. I'm going to send, like you said, blacklist. I'm going to whatever it is. You could program it any way you want.
Yep, you can do anything. It's a little bit too many degrees of freedom in my opinion, but yeah, you can do whatever you want. The thing I like to talk about is this idea of on-chain co-location. So if you're trading on a CLOB, you have this round trip time tick to trade is often what it's called. And you want that to be as small as possible so that you can have this shortest loop possible to react to what's going on chain, or sorry, on the exchange. And if you put some of that order execution logic inside your program, then you have almost zero tick to trade. For example, you might have logic that says, when I'm called, um, look at the Oracle update that you put in and update all of the quotes based on that Oracle update. That's how they all work. So a lot of the logic of the order execution strategy is moving on chain, and I call it on chain co-location for marketing, but it is an interesting idea that more and more logic that previously would have lived on your co-located server right next to the exchange is now living inside the Solana program, effectively living inside the Solana exchange.
And sorry to follow up, but if you have, let's just say, some equation, some interesting equation or model to price something, is it pretty hidden? As long as it's not open source, is it pretty hidden? It's hard to decompile it, or is it pretty transparent?
I think it's gotten a lot more transparent recently, just as the models have gotten better, the LLMs have gotten better.
I see.
It's definitely a little bit easier to tell exactly what's going on inside there. And then sometimes the routers will mess up and give away everybody's strategies. So at some point, OKX open sourced everybody's source code for some reason.
Wow.
And
Okay.
that was an exciting week as everybody looked at each other's source code and implemented all the secrets.
All right. Thank you so much. Appreciate it. Good work.
Hi, Max. Andrea Canidio here. I have
Hey,
a question about composability. So, are those things composable with each other? Like, can you, like in a traditional AMM where you could do many things, take out a flash load swap and here and there, or even just do some sort of routing computed directly on chain, or even just do a transaction that compares prices that you may get out of various of this prop AMM and then just decide to trade on the best one? That would be one question. The other question is whether the prop AMM is aware of who's the scheduler and adjusts the spread depending on what the scheduler, knowing that for some scheduler the Oracle update might not land on the top of the block, let's say.
yeah, so I don't see a whole lot of evidence of widening out based on the scheduler yet, but that's partially, I think, the scheduler stuff is really just starting in the last 1 or 2 months. So I would expect that we start to see that behavior soon enough, but I don't see any of that. I don't have any evidence that it's going on right now. I did, I mean, I do see that the markouts are different on the different schedulers, so I expect that everybody else will plot that and adjust. Um, to answer the question about whether it's composable, I just pulled up a swap. Um, you can see that it's hitting SolFi. It's also hitting an Oracle pool. If I look hard enough, I think we can find one that's hitting multiple prop AMMs. Let me see if we can find one on the next page.
So
Here's one that's hitting SolFi and Humidify here. So it is composable, yeah.
yeah, so but then the whole thing where prop like this prop AMM like widen and the strategically the spread, like wouldn't that be a way around that strategy where you can now play different prop AMM against each other to avoid this type of behavior? Because what do
Yeah,
you think?
yeah. So that's a great point. There is an implementation of the on-chain router by dflow. The issue is that we only have maximum 64 accounts that you can touch, and each account that you touch. So if you try to swap on SolFi, it's not just the SolFi program account that you touch. You have to touch like the a bunch of other accounts. So it's like 7 or 8 accounts per swap. I think this Humidify pool is 9 accounts. This SolFi pool is like 7 accounts. So you really have a maximum number of pools that you can sample from. And there's, as we saw with the Humidify, there's 5 different Humidify Sol USDC pools alone. So if you really want to touch all the pools, we don't actually have enough account space for you to do that. We're gonna increase the transaction size and then increase the number of accounts that you can use. But we should do that. Another interesting wrinkle in this is that we don't have partial reverts on Solana. So technically, if you wanted to, you could figure out that you're getting probed by an on-chain router, and then, for you would do this thing where you get hit by the on-chain router, you store the last transaction signature that touched you after reading the instructions this far, and then the second time it touches you, you give it a way worse price than the first time. So I think partial reverts plus more accounts plus this all this stuff, and then on-chain router would be very good. And it gives us a way to say that we have sort of verifiable best execution, which is also really good. But it's less simple than just hit all the programs and see what the best price is in practice.
All right, thank you.
Okay, question by Peter Makach.
Well, I was just wondering, on the slides, you showed the evolution of prop AMMs, or evolution of AMMs to prop AMMs, and there was kind of the last, I would say, evolution step. And I was wondering what's the difference between that one. So, right, the modern era versus the second triumvirate. What is kind of is it design? Is it liquidity? Is it something else?
So one thing is, like, if you look at the BisonFi markouts and then you plot like 5 second, 10 second, 30 second, 1 minute, 2 minute, 5 minute, BisonFi markouts get better over time. Everyone else markouts get worse over time. That's a sign that they're using some very sophisticated alpha about where they basically predicting the price 2 to 5 minutes in advance. That's something that nobody else is doing. I think mostly this is an era of just more sophisticated trading firms with better alphas than the previous. Like SolFi does not have a lot of alpha about where the price is going. Humidify and Tessera have a little bit more. The modern era folks, some of them are really sophisticated trading firms that are, top 3 in volume on Binance, and they really have a level of sophistication in their pricing alpha that is different than the previous era. That's the biggest difference. Yeah, there's probably other stuff, but I don't know it yet. But I'm trying to figure it out. They just came around recently.
Got it. Thank you.
A question by Sangan Ko.
Oh, yeah, but it seems like mine was already answered in the previous question, so
Okay.
I think we can skip on this one.
Perfect. Yeah. So last question by Reed Yeager.
Hello. Thank you, Max. Essentially, have we seen anything shift back to clubs or AMMs on Solana since has the cost and the inclusion chances gone up since prop AMMs have taken over?
Yeah, so certainly we're no longer in the congestion era of Solana. There's actually a lot less batching, although we had a period where there was very little batching. We increased the CU limit, and it was sort of almost a first come first serve scheduler for a while. That is ending as people figure out that if you do first come first serve, you don't make any money. But even in that period, the blacklist is really powerful for quoting, right? You can just say, I don't want to trade against Wintermute. You can quote a lot tighter when you don't have to trade against toxic flow, right? So that's one of the powerful things. But yeah, we haven't, it's just been up and to the right, the cannibalization of Sol USDC and other major volume continues monotonically. I wish I had that. I wish I had my heat map of just Sol USDC so you could see it over time. But you know, the right-hand side of the heat map, let me see if I have it here somewhere.
And as you're looking for that, just to follow up,
Yeah, go for it.
or around for the long term.
Sorry, well, you cut out in the middle of the question. What was the
prop AMMs, a fad that fades as things update, or staying around for the long term?
Oh, I would definitely say that they're gonna stick around. We already see them spreading to other chains. If you solve the router issues and it's just, I would say, dominant over the AMM situation. I think if we are going to do trading on blockchains, we already see a lot of the chains moving in this direction, but you're going to have sort of an on-chain black box where there's hiding, so you can't do a whole lot of MEV. There's censorship resistance. People are going to be piping in Oracle updates. You're going to have on-chain colocation. You're going to have programs that are doing all this stuff that they're doing today and more. I would say I'm very long on total volume share traded by prop AMMs in the global economy over the next 10 years. And they might look slightly different. They might evolve again, and it would be maybe even more integration between the routers and the prop AMMs. Maybe there'll be some standardization, but I expect that the sort of the enriched interface of prop AMMs for trading is likely to stick around if trading happens on a blockchain. If trading doesn't happen on blockchain, then I have no forecast for prop AMMs. But if it does happen on blockchain, I think that they're going to slowly take over the volume on all the chains.
Great. I think we are like right on time, just 4 minutes past 12:30 deadline. So I would like to thank all the speakers, Max and Alan, for two very interesting talks, and also all the audience for the great interactions and like Q&A. I think we all learned a lot from Max and Alan, and we look forward to the next webinars. So thanks, everyone.